It is definitely worth worrying about the UK's referendum on European Union membership in June, but the wall of worry may be getting too tall. Last week's current account data for the UK showed that the country and sterling rely very heavily on the kindness of strangers, to borrow a phrase from Bank of England Governor Mark Carney. That leaves the currency very vulnerable in the event that the UK votes to leave. But if you don't know this already, you're really not doing it right. The referendum in June is one of the most well-flagged risks in financial markets for this year. The currency has already dropped heavily in the run-up, and the options market, which reflects investors' expected levels of volatility around the vote day, has rushed higher. That means investors are braced for the worst. Really, the worst. Deutsche Bank, which is not exactly a fan of sterling's at the moment, suggests that the options market is reflecting something of a sense of panic. For options specifically around the vote day to make sense, it would have to be a bad day in the office for the pound, on the same scale as the collapse of Lehman Brothers or the UK dropping out of the ERM. It's not impossible to imagine that would happen, but it is pretty hard. Meanwhile, the euro really hasn't taken this on board at all. Traders aren't even paying attention to the other EU referendum. The Netherlands heads to the polls this week to vote on the EU's integration deal with Ukraine, something that's seen as something of a proxy vote on satisfaction with the EU and on relations with Russia. And if you're looking for a reason to be cheerful about sterling, it's worth remembering that central bank reserve managers have been amassing an ever greater proportion of reserves into sterling of late, with the share hitting 4.88% in the fourth quarter of last year from 3.9% or so at the start of 2014, according to the IMF. Those numbers are a little stale, but still, this is sticky, serious, risk-averse money. It feels like time to pause for breath.